Hey everyone, welcome to a very special edition. I'm so thankful to have Jack Hartley here from Stratex. We're going to be talking about a host of different things today. Crypto in general, all over the world, is experiencing a boom, and we are making a transition to this new digital economy. And the last time I had Jack on the show, he kind of blew me away with his knowledge. So I wanted to bring him back and really kind of pick his brain about where he sees as some of these topics. And so we're going to go through a ton of different things today. The conversation will be free flowing, but let me go ahead and bring Jack Hartley in, the CEO. Jack, are you the CEO of Stratex? What is your position there? I'm sorry.
Co-founder.
Co-founder. Yeah. Why don't you introduce us akin to who you are, Jack, and a little bit about yourself and just the bits and the bobs.
Yeah, absolutely. So hello, everybody. Thank you for having me, by the way, Crypto Sensei. It's a pleasure to be here again. My name is Jack Hartley. I'm on the board of Luna Digital Assets, which is a venture studio. We incubate early stage projects. We've worked with many projects around the industry, including Polygon as one of the more notable ones, and QuickSwap, which is another one that you may be familiar with. In my current work, I'm also co-founder at Stratex, which is a decentralized yield strategy marketplace where you can tokenize and insure yield strategies. So that's a bit of a mouthful. But what that means in practice is that users can get access to yield strategies that were initially the kind of domain of people that have been in the industry a long time and were very experienced and could put together bespoke strategies. But you can get access to that simply by buying a yield-bearing token, which is a much simpler user journey and user experience. And also there's an insurance component as well, so you can ensure that the funds that you put in will be returned to you as well, which is good.
I think that's one of Jack, when you were talking about this before, if people haven't seen that first interview with Jack and Alexi and the Flare team, go take a look at that, because there was a lot of really incredible things said there. But you brought up insurance, and more and more people are starting to ask me about, are there going to be products that are insurable? Like, what happens? Can you just maybe highlight a little bit more about that to help educate people on that?
Yeah, so the first thing I will say on the insurance is it's probably the most underserved part of the DeFi sector at the moment. And the reason it's underserved is because it's quite complicated. We are fortunate to have some incredible partners in Atomica. They're a insurance aggregator, so they pull insurance policies and they build insurance policies and broker them out to multiple different insurers. And they handle a lot of that for us, which is very fortunate because it's a complicated business. But to give you guys an idea of how this works, insurance can be multi-layered, and it probably should be to keep the cost reasonable. So you can have, so within Stratex's insurance stack, or insurance tower, as you might call it, you have at the top, you have the DeFi strategists themselves that build the strategies. We ask them to stake into the strategy to take the first loss risk. So if let's say 5 or 10% of the capital in the vault is owned by the strategist, then if there's a slight deviation, then they'll get slashed. And the reason they get slashed first is because that's their, it's their strategy that they've come up with. It's their kind of proprietary information, and so they should be willing to have a little skin in the game. Then at one level underneath that, we can build insurance products with the token itself. So similar to the way that Aave safety module works, where the governance token can be used to secure part of the insurance fund. And then as you go further down, then you can have a level of chain insurance. And so a chain, for example, Flare or any other chain, could choose to stake, a larger amount, 10 million or 100 million, into a insurance fund that covers all of the DeFi Lego blocks on that chain. And then at the bottom, then you can have brokered insurance. And the reason we put that at the bottom is it's a very important part of insurance, but it's also the one that you'll pay the most for. If you want to get a bespoke insurance policy that's underwritten by a third party, that's going to be quite costly, especially in an emerging sector like DeFi. Mm-hmm. And so what we try to do is we try to put a few different ports of call above that brokered insurance, which then overall hopefully will reduce the cost of the insurance. However, that being said, there's no such thing as a free lunch. So if you want to get 15% on a stablecoin deposit and you want it 100% insured, well, the insurance is going to eat into that deposit significantly. However, for a lot of people, in particular institutions, they're willing to take a lower return on investment with a large amount of capital but to know that it is insured and it's underwritten by a third party. And so there's a balance there. You know, a lot of the DeFi funds will have benchmark rates where they'll say, you know, we expect to clear a minimum of 10% on this asset and 15% on this asset, and so on. And so what you have to do, or what we have to do as a DeFi strategy platform, is to put the pieces together such that the fund is happy with the rate that they get, or the user's happy with the rate that they get, and that the whole thing can be insured in a way that makes it stable. And part of that, part of that is by doing things like only selecting blue chip assets and blue chip platforms, because if you're somebody that is into, you know, nascent emerging technology, then there's a tendency to go and use every new shiny thing. But the problem is, as many of us have learned over the years in this industry, you know, the Lindy effect platforms, the platforms that have been around a while, are usually the ones that will continue to be around a while. There's exceptions to this, of course, but we found that the protocols that are battle tested, your Aves, your Uniswaps, they're going to be the most stable thing to use, and they're also going to be the places where the deepest pools of capital are, and as a result, they're the easiest to insure. And so, by building strategies that are lower risk in the first place, then we naturally mitigate the cost of insurance kind of structurally.
Do you think insurance is one of those things that institutions are kind of waiting for? I mean, obviously you need regulation and you need to know when you buy and sell something, who owns it, and if it's sold on blockchain, do the same rights apply and all of those things. But it sounds like this is one of those layers that is a must for institutions. And it sounds like that's finally coming together. There's options finally coming to the forefront.
Yeah, there's a few different insurance protocols now. This obviously, I think Max, last time we were on, he was talking about Firelight on Flare, which utilizes XRP as the underlying capital to underwrite the insurance, which is incredibly clever. And we hope to work with Firelight in the future as we grow within the Flare ecosystem. But yeah, that you absolutely nailed it. The amount of capital that's waiting on the sidelines for tangible, salient insurance products is absolutely mind-blowing. Some of the conversations I've had with funds in the last 12 months are to the tune of, like, you know, we can bring 9 figures, but we need it all insured.
Yeah.
And so actually the problem is almost that the insurance industry that's very new within DeFi is going to struggle to scale to meet that demand, which is a great problem to have. But at the same time, it's, you know, insurance, like I said, is a complicated area. And so it needs a lot of smart people to put their heads together to really screw down on this and unlock all that capital that's waiting.
Do you see, and not to like talk too much about insurance, but I do think this is, you know, like we said, an important part to add to all of this. Do you see some of the larger institutions you know, building out teams to kind of come in and perfect this area of crypto? That way it can move to this new, you know, generation?
Yeah, I would be surprised if some of these insurance protocols are not acquired by the large insurers in the next 12 months. Because ultimately this is, you know, an economy of scale, and we need some of the very, very large insurance companies that manage, you know, multi-billion-dollar insurance funds and even larger. We need those guys to come on chain. There's a bit of a knowledge and skills gap where they can't build the team fast enough to understand this industry as it. The problem with this industry, with DeFi, is that the industry moves 2 paces forward, and then the TradFi guys, they move 2 paces forward to understand where the industry was, but then it's moved. And so what I think probably the best thing for these guys to do is just acquire some of the really good teams that are building insurance products and insurance aggregators, and then they don't need to close the skills gap because they've got it in-house.
I try to explain to the audience that there's only so much infrastructure, right, in this new digital revolution where, you know, blockchain technology is going to be used on a massive scale, whether it's stablecoins or whatever it is, CBDCs. And so, you know, I'd expect the BlackRocks of the world, the Fidelities of the world, these big institutions to start buying, you know, and I think that's why the Ripples and the Coinbase and the Circles have been trying to acquire the pieces that they can now, because once you get to a part where everybody wants the same thing, all of that infrastructure is going to be worth a whole lot more.
Yeah. And I would also say, you know, it's the industry itself needed to mature a little.
Yeah.
There's a difference between, you know, theoretically insurable and realistically insurable. And if you have something that was just built 2 minutes ago that, like, half the people that could provide insurance don't understand, it's going to be very difficult to attract the capital to insure that thing, which is why the DeFi industry, they kind of like built around this by doing things like first loss with staking and other stuff to kind of bridge that gap. But I think, some of the protocols that have been around a long time, like Aave, MakerDAO, Uniswap, they're legitimate revenue generating businesses that are insurable, that have known attack vectors, that have been attacked endlessly for the last 5 years and have proven to be able to withstand that. And so they should be able to be insured like any other business at this point. But that's not the same for the rest of the industry, which is like newer and more innovative. If you have a new hybrid lending market or whatever that's very innovative, the likelihood of you being able to get that insured is very low, because we know from looking at dozens of chains and hundreds of protocols that lending markets are one of the most attacked platforms in DeFi.
Yeah.
And so if that's the case, as an insurer, why would the insurer put their capital at risk knowing that you're building the thing that everybody wants to attack? It's a very difficult thing. Whereas if you take Aave, you can say, okay, that is the case for Aave, but Aave's been around a long time, and they've handled any issues that they've had very, very successfully, and it generates a ton of revenue. And so that's a different conversation, right?
Besides insurance, what are the most important pieces that you're running into, that you're understanding, that are, that we need these things put in place before we can make this, flip of the switch where everything goes natively digital?
So aside from insurance, that's obviously a big one to unlock the institutional capital. I think there was a lot of work to be done around regulation. If you'd have had me on, a year or two ago, I would have said regulation was the most important thing, mainly because for a time, it seemed like the regulation that was being put in place was drifting in the wrong direction. And a lot of the world is still to catch up in that regard, but the US seems to be doing some pretty cool work in making this a kind of almost like a special economic zone, but it's not really a zone because it's an industry that's global. But you get the idea, like an innovative industry that's allowed a little more of a longer leash than more established industries. And at the same time, it's been treated with being kind of welcomed in by the regulators now, which is very, very positive. And I think the US will benefit from a lot of talent acquisition for founders moving to the US to experience the infrastructure and the founder culture in places like SF. The crypto industry has been almost shut out of for quite a while.
Yeah.
On the flip side, though, you have Europe and the UK, which seem to be still going in the direction that the US was a couple of years ago, which is kind of regulation that sometimes lacks clarity, that doesn't really understand the industry on a deep level. I could give you an example of that in the UK. The UK has released some guidance. I don't think it's actually law yet, but this is the way that they're looking at this, which is that stablecoins in the UK, you can't hold more than £20,000 worth.
I saw that.
Which is like, that's a ridiculous thing to do, right? Like, first of all, like, why should the government limit the amount of profit you can take on a trade? As an example, if you for trading for retail folks is hard enough, and if you run the gauntlet of the dodgy exchanges and the scam wick candles and all the other stuff that make trading very, very difficult, and you manage to come out with some profit, why should it be the case that the government says, no, sorry, you can't hold more than £20,000 in stablecoins? Doesn't make any sense. It also means that any large players will be shut out of the stablecoin industry in the UK because it doesn't make any sense to be there. So this, to me, that piece of legislation kind of seemed to suggest that the UK government, they didn't really understand the industry, and they didn't really want to spend the time to understand it. And so they basically they pushed it out to the US. The US is doing all the innovative legislation. There's stablecoin issues that are well known and well regulated in the US circle and Tether. And so if they want to do the innovation, then they can. But in terms of UK citizens, they won't be able to access that, which is a shame.
Do you think that's a lack of is that a lack of understanding how important the technology is, or is it more of fear that they're worried that, because 99% of stablecoins is US dollar based? Are they worried about diluting their currency even more? You know, the British pound sterling.
Well, let's take it from first principles, right? The stable coins that are 100% backed in the US, what they are is a vehicle to buy and hold treasuries and receive a token that you can transact on the blockchain with. Why would a treasury want people to not buy its debt?
Mm-hmm.
It doesn't. To me, that doesn't make any sense. Like it really doesn't make any sense. Why would you want to limit the pool of people that buy the debt that you issue? I don't have an answer to that. So if it's not from a demand point of view, I think probably the issue is the government is unsure how the industry will fare long term, and they don't want to make bold, accommodating legislation if it turns out that some of these stablecoin issuers in the US, the large ones, end up having issues long term. And so they'd rather keep a kind of a more reserved approach and just say, you know, we're not involving ourselves in this new industry for now, and then hopefully they'll change their mind on it in a few years. But for now, it was an unfortunate thing to hear, because for the longest time the UK seemed to be attempting to understand this industry, and then there was some, you know, quite a few pieces of legislation in the last 2 or 3 years which made it clear that they weren't. So
do you think that is you know, and kind of coming back to this, is that a party thing? Because, you know, it seemed like one side here in America was against the digital asset space, and one side was for, and then once the one side that was for it got elected, now we have this harmonization of regulators and these new laws and rules that are being pushed forward to really help that innovation grow. Does that mean it's kind of the lack of leadership there that those people need to either be educated or maybe primaried against? I don't know what the term is there in the UK, but have somebody run against them that could maybe push forward the crypto agenda?
Yeah, it's hard to say, really. I mean, the one piece of evidence that that isn't the case is that we've had the first piece of legislation that came in that was quite anti-crypto was, I believe, the Financial Services and Conduct Market Act, which is a 2023 piece of legislation, which I think was when the previous government was in. And that was an opposition government to what we have now. And these two parties, the Conservatives and Labour, they're quite similar. They're both centrist parties. So it's not a wild difference. But I would say, you know, to have one party take a particularly negative or a misunderstanding view, to put it very lightly, and then the opposition party then comes in and does basically the same thing, makes me think that it's more of a almost a fear response or an unsure response from government. And I think what they want to do is just wait and figure out how this plays out in other places. But the problem is, because of how fast the industry moves, you can't really wait, because, you know, somebody's going to build $10 billion companies in the next year, and they're going to either build them in, you know, your backyard where you can tax them and regulate them how you see fit, or they're going to build them somewhere else. And, you know, that's one of those facts of life where if you choke off the growth and the innovation, then you don't get to reap the rewards of that further down the line.
It is kind of crazy how leaders of certain countries don't see the bigger picture here. And you would think they would have the information to see the bigger picture, that everything here is moving digital. We need to have a better financial system, not something that was created, you know, 60, 70 years ago, but something that is updated where we can move value instantaneously for little to no money. And like that just, I mean, it seems like that's the future. And you would think these people would try to capture that for the betterment of their country. But I guess
think so. I think that, you know, the other thing that's kind of silly about this as well is, you know, the UK and the US, the banks do a lot of trade between them. And a lot of the banks that exist in the US are the same banks that exist in the UK. You know, Citibank, for example, HSBC, and so on. So if you can have a very, very lax regulatory environment for digital assets in the US and a very, very stringent one in the UK, it's kind of silly, really, because you can have the same bank doing things on one side of the pond that they can't do on the other side of the pond, and it's the same people that run it. You know, it just doesn't make any sense to me. But what I think will happen eventually is the UK currently is struggling for growth. We've had a little bit of negative growth, actually, and I think as that starts to deepen and bite over the next 6 months, 12 months, if the US, sorry, can pull off some pretty big success stories in terms of their play in the digital asset space, if they can launch some unicorns, some multi-billion-dollar companies, then the UK will look at that and be envious, and then eventually the legislation will start to lessen. And I think some of the big institutions in the industry as well, like Coinbase, for example, are doing some lobbying. I noticed that they've started to put petitions out and so forth for UK citizens to sign. So there's some attempt to engage with government on this, which is good. That's what we need. We need industry experts to come in and say, hey, look, the approach you're taking isn't great. And so what we need to do is just take a step back, reconsider this, and then here's all the benefits that will happen if we engage positively with this industry. And ultimately, here are the drawbacks if we refuse to engage. I left the UK a couple of years ago because of this march towards negative legislation for my industry. Which is unfortunate. It's the place I grew up, and it's a place that I'm very fond of. But at the same time, it was more the direction that was the issue for me than the actual legislation itself. And so when you can say that the place where you live is taking a negative view of an industry that you love and that you put your heart and soul into and you spend all your time doing, then it's hard to justify why you would then contribute your economic energy to that system,
I know exactly how you feel. When we were kind of going through all of our growing pains here in the United States the last few years, it was incredibly difficult to be in this industry and be positive about it with all the negativity that we were seeing in the news. So I totally understand kind of where you're coming from. Just to talk, to kind of switch the conversation here about growth and innovation, we did have the SEC green light what is called the DTCC here in America, the Depository Trust Clearing Corporation, basically to allow them a pilot project to tokenize securities. So that's going to start in Q2 of 2026. And it does look like America is getting the pieces in place to use blockchain for not just the representation of those assets on chain, but also the settlement of those assets on chain. And so you start to wonder, how far behind can the UK or the EU be here? Do you have any knowledge about the EU? Are they
some peripheral knowledge, not a ton, mainly because a lot of in a similar way to the UK, a lot of the large crypto companies that were based in the EU were scared off over the last few years. So it's kind of in this industry, you interact with a lot of people that are based in jurisdictions that are suboptimal for legislative reasons. Nobody really wants to be based in I don't know, like Panama or wherever, because it's not optimal for business, but it's optimal for legislation. And so there's a little bit of that. But on your point about the new SEC guidance, I think this is really interesting. For the longest time, many people in our industry have been speculating that when all of the governments and the regulators will strongly get behind this when they start tokenizing equities, because they'll see firsthand the benefits of tokenization and instant settlement and instant transfer and everything else that happens to remove like 5 layers of bureaucracy that is in the current system. And when they get that kind of like aha moment, as soon as they do this and trial it, and like, this is like 1,000,000 times better than what they're using currently. A lot of people don't realize how inefficient that legacy system is, and how some parts of even with equity trading generally, where the front of office doesn't talk to the back of office until the close of trade, and there's like just tons of inefficiencies there that could be settled. And blockchain's perfect for that because it's immutable, it's auditable, it's transparent, it's instant. It's not instant, but it's relatively instant settlement compared to traditional equity settlement. It's like seconds as opposed to hours or whatever. So I'm very optimistic, and a lot of big players, Larry Fink from BlackRock and others, have been talking about this for a long time. And these are the guys that push the regulators and push the legislators to do what needs to be done to move the economy forward. And when these guys see the benefits, I think that will help generally with the industry.
People are always really, kind of caught up in timelines. How long is this going to take? Maybe some people have been here for years already. Realistically, with what you're seeing now in the market, where do you see a fully regulated institutional crypto market where we do have that parallel system up and running? Is that in the next 5 years, 10 years? Is that longer in your opinion?
I think probably less. Now, the thing to bear in mind is the traditional bureaucracy in government moves very slowly.
Yeah.
And this is also affected by changes in government. So whenever you say a 5-year timeline, unless you start talking about at the start of an administration, you're going to run into change of administration, change of outlook, change of faces, and that brings with it uncertainty, which is an issue, of course. But I would say, I actually think we're closer to 3 years for tokenized equities becoming a reality. I know they're doing the pilot scheme. I think that'll be very, very successful. And because of that success, the people that need to understand this will realize the amount of money that's on the line to potentially be saved, and then they'll start pushing aggressively in that direction. Doesn't mean that the infrastructure is there right now necessarily, but I think the people that want to do this have probably been building some of the infrastructure for a while. I would be surprised if the large funds and the large entities, BlackRock, Vanguard, and so on, don't have interest in companies that are already building all of the infrastructure that's required to do this. And those companies will just pop up seemingly out of nowhere at the right moment to facilitate everything that needs to be done here. Because a lot of this stuff is kind of as soon as the big players like Fink and others flip bullish on this industry, you can start to turn the cogs in your own head, and you think, okay, for him to be bullish on tokenizing equities, being the man that he is, an incredible strategist, he's probably thought 15 moves ahead, and he's probably already owning or paying for some of the teams to build out the infrastructure, so that 5 years later, when this is a reality, he owns a lot of the core infra.
Well, you have the problem here where it's just like with AI and robotics. Now that it's there, companies are forced to use it and adopt it, because if they don't, their competitors are, and that gives their competitor, right? And so that is the same thing that we're experiencing here now with the digital asset market. If a country has the infrastructure up in the competitor country, or a country that relies heavily either on trade or whatever it is, right? Now they're at a disadvantage. And then also all of the companies and corporations in those specific, right? So it really does start a arm race, but with digital assets and crypto. And that's what everybody holding crypto wants to see, right?
Well, look, these funds, the larger funds, because of the amount of money that they have to move around, they deal in the trillions, and they're happy to get single digit returns on that, as long as it's consistent. And so if you can shave off 1% from the bottom line of that company, that is absolutely massive. And so and again, with when you talk about inefficiencies, it's always better to save than to earn, because you don't pay tax on what you save. And so I think as soon as these companies get wind of the amount of efficiency and just in general enhanced ability that this could bring, I think they'll go all in and very aggressively.
Where do you see stablecoins going? I mean, obviously we've talked briefly about what the UK is doing, and obviously that's probably not the winning strategy for stablecoins, but globally, how does this fit into what you're doing at Stratex? And then also, how do you see stablecoins on a global level, on a macro level?
So stablecoins are an incredible innovation. I don't think they get enough props, to be honest, because they allow you to take something that is, a tier one cash reserve, a tier one asset, cash or cash equivalent as a treasury, and take that a very, very strong source of capital, and then interact with all of the nascent emerging tech that exists on the blockchain. And that's not an easy thing to do and maintain. And we know this is not easy because of the absolute graveyard of stable coins that have died and lived and died over the last 10 years. So there's like literally hundreds of them. A few notable mentions is UST, of course.
Rest in peace.
Right. And even Binance closed its I think it was BUSD, wasn't it? They had some issues from regulators I don't know if they may have restarted it now, but I think there was some talk a few years ago when the stablecoin issuers were getting hammered. There was some issue with Binance. There was no it didn't depeg or anything, but I think there was just talk. You can fact check me on that one, but I'm pretty sure there was talk of it closing or relocating. So look, Stablecoins are an incredible innovation. I think there's still work to do. I'm a big fan of the decentralized stablecoins. I think, careful, I'll say this. I think there's a very good chance that an innovative team is working on a privacy-based stablecoin at the moment that could turn some heads in the next 12 months. But it's a very, very difficult line to walk, because whenever you get stable coins, you get heavy KYC requirements for the minters and the issuers, and that causes a problem when you talk about privacy. So, if such a stable coin was to be born, it would have to be done in a very sensitive way to make sure that it didn't fall foul of all the legislation and so on around that. And it's a difficult thing to do, because if you have something that's backed by a treasury, it's not technically a US dollar, but it is essentially a US dollar in function. And especially when you've got crypto POS payments and other stuff that you can pay for goods and services for in person, you have to be careful that you don't give, bad actors, terrorist organizations or whatever, access to the US dollar anti-money laundering chain, essentially. Yeah. Not chain as in blockchain, but the chain of custody is what I'm talking about.
I think.
Yeah.
Oh, sorry, Jack. Continue.
No. So my main point with this is, I think stablecoin tech is underrated. In terms of what we're doing at Stratex, so what we obviously accept stablecoin deposits, and then we allocate that out in the most efficient way possible, or we encourage strategy builders to allocate that out in the most efficient way possible to get the highest return. And we can use a bunch of different DeFi Lego blocks to achieve that. And so the idea is that we target above the industry standard rate of return for stablecoins. We draw that from a diversified basket of different sources. And so there's no chance that the pool that you farm in is going to lose rewards, and then you're going to lose, your opportunity there, because it's spread out across maybe 10 different areas. And so in doing that, we produce a yield-bearing version of the underlying asset that hopefully delivers a high but sustainable yield over the long term. So that's the kind of to tie that knot for Stratex.
Mm-hmm. Thank you. And kind of stable coins does fall similar lines to central bank digital currency. And I know this is excuse me, a growing conversation globally. I know that 90-something% of central banks around the world are either piloting, testing, doing some type of engagement with either wholesale or retail CBDCs. Where do you see this going? Is this something that has to happen too, to make all of these other things work with tokenization and institutions using crypto to move value instantaneously? Like, is that part of this, or can central bank digital currency wait another 5 or 10 or 20 years to develop, and all of this other infrastructure is the most important?
Okay. Maybe this is a controversial opinion. I don't know. It depends really, but I would say I think that CBDCs are a massive risk to the general population. The reason being, we know that the use of surveillance tech and this kind of like government control infrastructure has increased massively over the last 20 years as digital innovations have come forth, and now things such as gait recognition, facial recognition, biometrics, and so on. All that's been knitted together by some quite smart AI systems. If CBDCs are largely implemented at scale and in some sort of digital wallet system that's compulsory, it becomes a very tempting prospect that a government in the future, no particular government here, I'm not talking about the UK, Europe, or the US, or any particular party, but it's a tempting proposition that a government may emerge in the future that wishes to control a citizen's access to commerce because they have unfavorable political opinions, and they will have everything they need to do that. So the current situation is, if you live in a despotic regime that is very much against your worldview, if you have cash, you can still transact as a private citizen. If you have crypto, if you have Bitcoin, you can use Lightning Wallet and you can transact as a private citizen. XRP, same. However, if CBDCs become widely implemented, the ability to turn that off or debit that account to zero, if for whatever reason you fall out of favor with the current administration, is a very simple and easy thing to do. And then the only thing that prevents that from happening is whether or not the government is despotic enough. Now, we know from history that occasionally authoritarian regimes exist and crop up from time to time in multiple different societies in Europe, as they have done in the East, and lots of different places in between. So again, I'm not highlighting any particular regime here. My point is, historically, it's a risk that occasionally you get an authoritarian leader in a developed country. And I don't want to give them the tools to be able to do that to a private citizen. So I would say that, in my opinion, CBDC should not be pursued. However, they are being pursued and they will be pursued. So the second best option is to give people an alternative. And that's where the fact that private companies minting stablecoins by maintaining a supply of treasuries is a good third-party step. It's not perfect, because then the treasury, in theory, the treasury, the faucet of treasuries that the stablecoin issuer is buying from could be cut off. There's a bunch of legislative action that could be taken on the legal entity. However, it's a better solution, because the third-party issuer is going to comply with any lawful demands and probably not comply with unlawful political demands, like, I don't like this guy because he voted for somebody else, for example, which is a good mitigating factor. However, the perfect scenario would be a decentralized, privately issued stablecoin that's run completely decentrally, that's issued by consenting third parties on a network who don't know each other, who have no common interest. And if that emerges, then that would be perfect. And this is kind of similar to the direction that MakerDAO was going originally. Now, obviously, MakerDAO, they're a brilliant company, very innovative, and I can't speak highly enough of them, but they've tended over time to go down the more centralized route. They started with them including things like USDC in the basket of collateral, which meant that the access to treasuries as opposed to just relying on ETH to back the DAI. That's kind of how it started, and now they've had a more formal transition into Sky, which is the new entity there, and so they're pursuing a more centralized route, which is understandable given the current climate. But I would just say, I think somebody out there needs to keep that flame of decentralization alive. I think there should always be a decentralized alternative. So yeah, that's kind of my take on stablecoins.
And so, when you were talking about CBDCs, you were talking basically about a social credit score where, anybody could, track your movements and could even say, we're going to issue you this money, but you need to spend it on such and such in this time, or it expires, right? Or they could just expire it, right? I think that is a really big concern for a lot of people. And something like a digital bill of rights globally might be something that, I don't know, institutions maybe like the UN or something like that would need to be put in place.
Yeah, so we actually know that they are going to do this as well on the time deposit thing that you mentioned, because this was in all of the trials that I've seen on CBDCs. They've always mentioned time expired deposits, and the reason they want to do this is because one of the main reasons you would introduce a CBDC is to give the ability to modify consumer behavior to the government. So the problem, there's a paradox called I think it's called the paradox of thrift, or the crisis of thrift. But basically what it means is it's an economic principle whereby if you have a population that saves a lot, that's a positive thing up until a point. But if they save too much, then it means that the flow of goods and services stop circulating as it should in the economy, and the economy stagnates, and that causes massive problems. So you start off with something that's a positive, which is a high rate of saving in the population, and it ends up having a negative effect. Now, if you had time deposits, then the way you get around that is you say, okay, great, you can save, but anything over 10K that you've saved, then, we're going to put a 3-month delay on. So if you're saving up for something like a car, then great, because you can buy that within that time. But if you're just saving relentlessly because you're a thrifty person, then that's going to cause a problem for the economy. Now, this is the benign view of CBDCs, but another scenario is like, look, you offend somebody in a political office, and suddenly you have to spend the money in your account within a week, and then you get debanked. This is like the direction it can go, and my whole thing is, why would you allow, why would you cede that power to manipulate human behavior through commerce in that regard to government unnecessarily if you don't need to? There's no real reason for it, because the consumer kind of boom bust cycle and the different attitudes of consumers has been well mapped and studied for hundreds of years, and so we've got a very good understanding of how to mitigate various factors that go into human decision making. We don't need to give a ton of power and control to a centralized entity like a government to take that decision out of your hands, you know?
Yeah, I think what you're talking about is a stimulus, right? When governments need to inject capital through stimulus, and then universal basic income is probably something you're going to see in certain countries over the next 5 to 10 years, I would imagine. Depending how bad AI, puts everyone out of work, I'd imagine that some people are going to need some of that. But
if I could just piggyback on that point about UBI, so I'd like to introduce a concept that I've been thinking a lot about over the last few months.
Love that.
So apologies if this concept has already been thought of by some smart person that I've not come across. So I'll hold my hands up. This may not be an original idea, but I've been thinking about it a lot. So yeah, you always have to do that because the internet's vast and somebody's almost always thought of the thing that you've thought of. So
probably.
Okay. So I would say instead of doing UBI in the sense that you're going to give people, $1,500 a month or whatever, or $2,000 a month to augment their lifestyle if AI takes their job, I think a much more sensible way of looking at this is also UBI, but we change the I from income to intelligence. So imagine this. Instead of you getting a stimulus check from the government because you can't compete in an AI-driven economy, you get a productivity boost in AI that helps you compete at the highest levels in your sector. And so the government could do this. They could trial this right now with things like, free subscriptions to ChatGPT Pro as an example, or encouraging the use of ChatGPT or Claude or whatever in schools. And as we get a little further down the AI rabbit hole and we start to get into wearable tech that's AI driven and augmentation eventually in a multi-decade timeline, then that could be delivered as an IQ boost. Imagine how much more powerful it is. Instead of saying to 95% of humanity, you can't compete and you won't ever be able to compete, so here's $2,000 a month to live on. Instead of that, how about we give them a 200-point IQ boost? And suddenly every human on the planet can be competitive in an AI-driven economy. And suddenly we unlock a massive amount of potential for human flourishing that doesn't exist right now. There's no way to do that right now. But I think AI will solve that problem of how to implement things like this within the next 5 to 10 years. And I think what we should be doing for people is giving them, a hand up and allowing them to join the new economy rather than giving them a handout from the product of that economy. That's my personal opinion.
I think that's a great idea. I've been trying to educate people over the last maybe 8 to 12 months that, you need to be spending at least 30 minutes a day using AI, understanding it, because that could put you at a difference between you and the person sitting next to you, right? And if it comes down to who knows how to use the technology over somebody that doesn't, you might keep that job, but you also might get an additional bonus as they get rid of the other 10 people that also do your same job, right?
AI, it doesn't have to automate jobs away, but what it does really, really well is it closes the skills gap between a good worker and an excellent worker. Because suddenly you have a scenario where the guy that's got 5 years experience on you and maybe 10 to 15 points higher IQ than you have, you can close that gap with just ChatGPT 5.2 for like $30 a month, because that will have, every scenario that's ever happened related to your type of business is in there that you can probe, and you can get it to do models and forecasting on agent mode that are very, very deep and complex. Obviously, you have to be there to sense check it, to ask for verified sources, to make sure that you're not kind of drinking the Kool-Aid that some of these models can spit out occasionally. But if you want to close that skills gap on the top performers in your industry, you can do that pretty effectively now in a way that you could not do, 5 years ago. So I would urge anybody listening to really get familiar with these tools, get over the inertia of starting to use them, and spend, an hour a day, start several different conversational threads, perhaps do one for health and lifestyle, one for philosophy, if you're into that type of stuff, one for your work, and then a general queries thread, and allow the model to start building context and understanding on you, so that then when you come to it with a query, it has a much deeper understanding of what you're trying to achieve and why. Some of these models, you can even program meta prompts. So you can go into the section that's like kind of your area in the app, and you can give it a prompt, like a paragraph of text that sits above as a directive above all the prompts that you give it. So you can tell it to be skeptical, to be adversarial in its reasoning, to be somebody that steelmans opposition points. And that in doing so, you guide the model to give you the type of response that you want, rather than getting the kind of sycophantic, hey, this is an amazing idea, you should take this and tell 5 people, or whatever it says to people that don't have this kind of stuff, because that's one of the biggest issues that people run into when they start using the model, is the model tells them that they're great and everything's great and every idea they have is great, because the model's trying to optimize for user time on the app as well as giving you the right answer. Because ChatGPT or whatever, they have 2 guiding things, which is they need to make money as a private company, and they also want to give you the right answer. So they make the models very friendly so that you spend more time on the app, but then you almost have to like deprogram that out of it with a meta prompt, so then you get useful information.
Man, we're getting an education here on how you can properly set up your life with AI. I love that. Jack, there's probably 100 things that I don't know about you, and things that maybe you are extremely interested in. Is there any topic or something that you'd want to bring up and have a conversation about here? I wanted to at least give you the floor to say anything, or bring up anything, and that we could have a discussion.
I guess I'll just use the time to go a little deeper on AI, because I think this is probably the most profound issue that your audience will ever have to tackle in their life, is what is their relationship with AI, and how much should they use it, to what degree they should employ it. And the consequences of those decisions will probably ripple out a lot farther than people know. If you choose, there are many people that I know that are quite adversarial towards AI in general, and they want to basically not have anything to do with it. They don't want to include it in their life, and they want to basically they're a little suspicious of the people behind it. They're suspicious of the tech. They're unsure, and they want to distance themselves from it. I think that will become increasingly difficult over the next few years, and you'll get to the point where you genuinely may get left behind. I think I'm an advocate of the UBI, Universal Basic Intelligence, where these mega giga AI companies end up helping people adapt and grow in this industry. But there is a level of consent required to do that. So I would say, for anybody that's unsure, just start using the basic free versions. If you're a member of X, then you obviously get Grok for free just in the app there, which is really easy to use. I think there's a ChatGPT that's free. It's better if you use the pro version, because then you can do more stuff and you get more credits and stuff. Just much better experience. But it's not expensive. It's like $30. It's like the cost of a gym membership. It's well worthwhile. And just start building it into your daily life and routine. You don't have to, if you're somebody that's more skeptical, don't give it personal information about yourself. If you're unsure about your data protection, just give it general questions and hypotheticals about somebody that might be in a scenario that you're in, without giving out too much information about location and other personal details. But definitely start grappling with it, because as soon as we reach what AI researchers call fast takeoff, which is where the AI is good enough to improve its own code such that the next model gets generated quicker, then things are going to get crazy really quick. There's obviously a non-zero chance that the end result of that will be not great. However, I would urge listeners to think pragmatically about that. So whilst that scenario of things not going great might result in a very, very suboptimal outcome like human destruction, it's kind of like a train that won't stop. So the AI companies, the economic gravity well that we've fallen into with the amount of money that's been invested and the amount of development that's gone into this, excuse me, means that the economic incentive is absolutely profound for this to continue. And not only that, but there's an adversarial element with other nations as well. So if you notice, the National Defense Authorization Act was reauthorized recently by Congress. And that included a provision for AI this time around, making it a national priority for defence. And that shows you that even at the highest levels of government and the defence industry, they're taking this very seriously. China, in terms of the number of research papers published, is outcompeting the entire world on AI development, not in terms of the cutting edge models, but in terms of the amount of research bandwidth that's gone into it. I think something like over the last 2 to 3 years, it might be 2 years, since 2023, there's been about 100,000 papers published on AI in total globally, and the majority of them are from Chinese researchers. So when you get into the nation-state adversary mindset with this, you know that your key strategic adversary is developing this stuff as fast as possible. They're teaching their young people and their students in university to prioritize this. They're implementing that. China's focus is very much on practical implementation, which is a little different to how we think about this in the West, which is in the West, it's more focused on big picture, like make the kind of like build the AI god and then let it solve all of our problems, rather than implementing AI on a piecemeal basis as each new innovation occurs. So we're taking slightly different approaches. But my point is that there's an adversarial incentive, which is the AI race. There's a defense incentive through the National Defense Authorization Act, and there's the economic incentive. So when you have all those things together, you get to a situation where this is basically an unstoppable force. And so what your listeners should think about that is, okay, the kind of zeitgeist, the current movement in the globe is to build these things. And so what does that actually mean for me as an individual? And right now, what it means is you should familiarize yourself with the tools as fast as possible and implement them, because they're going to become ubiquitous in your life. You're going to see them everywhere. They're going to be implemented in as many places as possible, for good or for bad. That might end in like Armageddon and human destruction, or it might end in infinite human flourishing across the globe with billions of people uplifted out of poverty and able to contribute to the human story. And that's an incredibly compelling reason to do it. But it doesn't matter about the reason to do it. What actually matters is what the reality is. And I think the reality is that we're going to get there one way or another. And so we should think pragmatically about how do we use these tools and how can we benefit from this as individuals.
I think that, governments, especially some of the things that you mentioned, I mean, you're starting to see a lot of different AI used in defense stuff, right? With different robots and all kinds of things. And I think, not to get too deep into what's going on with Russia and Ukraine, but you are seeing, Ukraine using drones with AI to make sure that targets are hit even when jamming is done too. And so I think this really is not just focused on warfare, but kind of every single aspect of our economy will be touched by AI. And I think people need to understand how important that moment is. Like right now, you need to be learning as much as you can, as quickly as you can. And of course, it could lead to, us becoming a big ash cloud, but it could also lead to the next evolution of mankind.
Right. So, and in the ash cloud scenario, that would be very unfortunate, but it also wouldn't be your issue because it's done. You don't need to worry about that scenario because it's over. It's done. So
that is true.
I think look, you probably got this from speaking to me, but I'm a pragmatist. I think about things that are pressing and immediate and inevitable. And when they get to that point where I go across the kind of event horizon of what is inevitable and what isn't, I'll go all in on trying to figure out how to best implement it. For a long time, I was kind of an AI, not a laggard, let's say, because we're nowhere near that part of the adoption curve yet, but basically somebody that was a little reluctant to engage with this. I kind of grew up on movies like Terminator and Skynet and was a little bit unsure how to pass this new reality when ChatGPT, I think it was ChatGPT 2 that came out, or 3, and I was like, this is really interesting. So, and then as you start to use the model and understand what it is and what it isn't, and understand the direction that these companies are taking it, and the economic and the political incentive to do it, you realize that, okay, if this is the new reality, then what we should do very quickly as innovators in this space is try to practically apply that to as many areas of your life as possible to get maximum benefit. We saw in our lifetimes, we've seen several waves of technological innovation. The advent of home computing, the advent of the internet a little later, and then cell phones and smartphones a little after that. And now, of course, the industry that we're in, which is cryptocurrency. And we know from those 4 different waves of innovation that the people that adopt the technology first and go through the clunky, difficult to use phase where you're not sure what the practical application will be, but you're interested, you want to tinker with it, those are the people that end up doing very, very well in the later stages as the early majority and the late majority come in, because they've already set up the companies, they understand the infrastructure, they've applied it in their business. And so that's kind of where we are now with AI. It's an interesting, some people use it as kind of a life coach. It's kind of an interesting thing to talk to about, how to bake a red velvet cake or where to go out to dinner on a Friday night. But at the same time, it can build you a 10,000 data point model on what the next 10 years are going to look like. So it's up to you how you implement that in your life. I would urge people to go more complex than less complex, but using it for anything is better than not.
Well said, Jack. Listen, I want to thank you so much for your time and your expertise. Guys, if you're just kind of catching up on this conversation, go back and watch the whole thing. We covered tokenization, we covered stablecoins, we covered CBDCs, we covered AI, we covered, of course, what Stratex is doing, we covered insurance and so many other things that are going to help you understand where this market is heading and how you can properly prepare yourself to take full advantage. Jack Hartley, co-founder of Stratex. Anything else that you want to say, Jack, before we kind of close out here? I know your time is valuable. We're pushing the top of the hour here.
Yeah, no, I would just like to thank you for having me on. It's been an incredible conversation. You do great work for the community, both the XRP community specifically with all the content that you produce, but also the industry in general. And the industry needs good content creators. So thank you very much.
Hey, it's an honor, Jack, and thank you for sharing all of your knowledge, because you are one of the smartest people I've had a chance to interview, and it's just thank you for the time and the energy and the know-how. All right,
guys. Catch you
all
on the flip side.
Ciao. Thank you, guys. You guys have a great day. I will see you tomorrow for the stream. Aloha, everyone. Peace out.